Welcome back to LexTalks, Legal Topics Simplified, where we break down complex legal topics and make them a little less intimidating. Today we're diving deep into something that's been shaking up the Indian financial scene, amalgamation of banking companies.
Yeah, it's a pretty big deal.
So for anyone who's not quite sure what amalgamation really means, could you give us a quick breakdown? It's not just your average merger, right?
Right. It's a full-on integration. Think of it like two rivers meeting and becoming this powerful new stream. Assets, liabilities, employees, it all combines into a brand new entity.
So it's not just addition, it's creating something totally new. And this whole process is guided by the Banking Regulation Act of 1949. Serious legal stuff.
Yep. Section 44A of that act is the rule book for these amalgamations. It's fascinating how laws shape these huge financial shifts.
Now, here's where it gets really interesting. The Reserve Bank of India, the RBI, has a lot of power in this process. They're not just watching from the sidelines.
Oh, yeah, they can actually orchestrate these amalgamations. In some cases, the RBI can even force mergers if they think it's needed for the stability of the whole financial system.
Talk about a power move. So why would banks even want to go through all this? Combining entire institutions sounds like a logistical headache.
It's a huge undertaking, that's for sure. But there are some big incentives.
Hmm.
Think about India's economic goals, things like infrastructure development and renewable energy. Those need serious financial backing. Larger banks, the kind you get through amalgamations, are better equipped to fund those huge projects.
So it's not just bigger is better. It's about creating institutions that can handle those national level projects.
Exactly. And it's not just national goals either. Amalgamations can help banks become more efficient, offer better customer service, and compete on a global scale. We're talking about building national champions in banking.
Makes sense. It's all about creating a stronger and more competitive financial system. But we can't forget about international regulations. Those have an impact, right?
Oh, absolutely. Basel III Norms, for instance, those global regulations require banks to hold certain capital levels for stability. Amalgamations can be a way to meet those requirements and stay in the game.
Got it. So we've talked about the why. Now let's get into some real-life examples of these banking amalgamations. There have been some pretty big ones recently, right?
Definitely. The one that probably comes to mind for a lot of people is the 2017 merger of the State Bank of India, SBI, with its associate banks, and on top of that, Bharatiya Mahila Bank. That mega merger launched SBI into the top 50 banks worldwide.
That was huge news. But it had its critics, right?
Oh, for sure. Some called it the Great Indian Bank Robbery, though they were being a bit tongue-in-cheek. But it does show the sheer scale and impact of these moves and how even seemingly positive changes can be met with skepticism.
Good point. It reminds us that even in finance, perception matters. What about examples from the private sector?
Of course. Take HDFC Bank's merger with Centurion Bank of Punjab back in 2008. This was less about becoming a global giant and more about strategically expanding within India, giving HDFC a much wider reach.
So different motivations, but the outcome is still these larger, more powerful banking entities.
Yeah.
Any other big government-led initiatives like the SBI one?
Yeah, in 2019, the government had this big consolidation plan, merging 10 public sector banks into 4. This created some massive players, like the new and expanded Punjab National Bank.
Wow, so amalgamation has been a major force shaping the Indian banking sector, and it seems like it's only gaining momentum. Let's switch gears a bit now and look at how this process actually works. How do two banks, with all their systems and employees, actually become one?
It's a complex process with a lot of steps and people involved. It all starts with the decision to merge, which can be initiated by the banks themselves, kind of like a love marriage, or orchestrated by the RBI, like an arranged marriage.
Uh-huh. There's romance in banking, too. What happens next once they've decided to merge? It can't be as simple as signing a paper, right?
Not at all. The next step is creating the scheme for the amalgamation. This document outlines every single detail, from the share exchange ratios to the handling of assets and liabilities. But importantly, it also details how employees from both banks will be integrated. This part is often the most sensitive since it involves people's livelihoods.
It's like merging two families, not just two businesses. What hurdles are left once this scheme is done?
Well, that's when the real test starts. First, you need shareholder approval from both banks. Then, the creditors need to be on board, making sure everyone who's owed money is comfortable with the new arrangement.
I bet there's a lot of negotiation and compromise involved.
You bet. And once the shareholders and creditors agree, the scheme goes to the RBI for scrutiny. They check every detail, making sure it aligns with regulations and the overall financial stability of the system.
Must be nerve-wracking for the banks.
Absolutely. But even after the RBI gives the thumbs up, there's one last step. The final approval comes from the central government. It's a multi-stage process with a lot of checks and balances.
It makes sense why there are so many layers of oversight. Such a big change to the financial landscape.
Right. And then there's the National Company Law Tribunal, the NCLT. They make sure the process is transparent and considers all the stakeholders' interests.
So the NCLT acts as a watchdog, making sure everything is above board.
Exactly. They require banks to publicize their plans, inviting objections from anyone, customers, competitors, anyone who might be affected. It's all about fairness and maintaining public trust in the banking system.
That's an important point. It helps ensure that these amalgamations aren't happening in secrecy. So as you can see, amalgamating banking companies in India is a carefully planned process with legal provisions, regulatory oversight, and stakeholder interests all woven together.
It's definitely a complex process.
It is much more complex than I initially imagined. But it's fascinating how law and finance work together. Now, while we've talked about the upsides, it's important to acknowledge that bigger isn't always better. What are some of the potential downsides of these mega mergers?
That's a good point. You're right, there are definitely challenges and risks to consider. Sometimes creating these huge banking giants can lead to unexpected problems.
I can imagine that managing such a massive organization can be tough.
Exactly. Sometimes amalgamations can lead to inefficiencies and customer service issues, especially in the early stages of integration. You're blending different systems, processes, even company cultures. It can cause disruptions.
And if it's not handled well, those disruptions end up hurting customers.
Absolutely. We saw some of these downsides after the 2019 mergers, where customers had service interruptions and some employees weren't happy with the changes.
That must have been frustrating for everyone. Are there broader economic concerns we should think about?
Yeah, one valid concern is that we could see reduced competition. Fewer, larger banks could mean fewer choices for consumers and potentially higher costs for banking services if things aren't managed carefully.
So there's a balance to strike between consolidating the banking sector and keeping healthy competition alive.
Exactly. That's why institutions like the RBI and the Competition Commission of India, the CCI, are so important. They scrutinize these amalgamations closely.
They make sure everything is done fairly and in everyone's best interest, not just the banks.
Precisely. They have to weigh the benefits of consolidation, like increased efficiency and financial stability, against the potential harm to competition and consumer welfare.
It sounds like a tricky balancing act.
It is. But now let's shift our focus towards the future. Finance is constantly evolving, with new technologies and players emerging all the time. How do you see this trend of banking amalgamation playing out long term?
It's a fast-moving world out there.
Yeah, and I think consolidation in the Indian banking sector is almost inevitable, considering the pressures of the modern financial landscape.
What kind of pressures are you talking about? Is it just about keeping up with international competition?
It's definitely a factor, but there's also the rise of digital banking and fintech companies. These new players are nimble and innovative, putting pressure on traditional banks to adapt or get left behind.
So these mergers are partly a survival tactic for the big banks, a way to bulk up and compete in this new digital age.
In a way, yes, amalgamations can give them the scale and resources to invest in new technologies and talent to compete. And let's not forget those constant regulatory pressures like Basel III norms and capital adequacy requirements. Those also encourage consolidation.
So a combination of market forces and regulations pushing the industry towards bigger players. But does that automatically mean a better banking experience for the average person?
That's the million-dollar question. Just merging on paper isn't enough. Success depends on how well the integration is done. If banks can't blend their operations, systems, and cultures while keeping customers happy and compliant, the whole thing could backfire.
So it's not just about getting bigger, it's about getting better. Integration is key.
Precisely. If done right, amalgamation can lead to a more robust, efficient, and globally competitive Indian banking sector. It's a dynamic process with high stakes and lots of moving parts, which makes it a fascinating area to keep an eye on.
Absolutely, it's definitely a space we'll be watching closely. But before we move on, there's a specific aspect I find really interesting. We've talked about the financial and regulatory side, but what about the human element? These amalgamations impact real people, their careers, their finances. How are individuals affected by these massive shifts?
You're bringing up a crucial point, and it's often overlooked in these discussions about mergers and acquisitions. You're right, these amalgamations have a huge impact on employees, customers, and even whole communities.
Let's start with employees. Mergers often lead to job losses, don't they? It must be a stressful time for those working in banks going through these changes.
Yeah, unfortunately, you're right. When two banks merge, there are often overlapping roles, leading to redundancies and layoffs. Even for those who keep their jobs, there's uncertainty and transition as roles shift.
It's like adapting to a new company culture, even if you haven't technically changed employers.
Exactly. And it's not just about job security either. Integrating different work cultures can also be tough. You might have clashing values, management styles, different ways of doing things.
So it's not just numbers. It's about people navigating these big professional and even personal changes.
Absolutely. And it's important for banks to recognize this human side of integration. Clear communication, empathy, and support during these transitions are essential for keeping morale up and making the transitions smoother.
It's about people, not just profits.
Right. And speaking of transitions, how are customers affected? It can't be easy to adjust to a new bank, new systems, maybe even new branches.
That must be a lot to take in.
It can definitely be disruptive. Customers might have changes to their account numbers, branch locations, even the services they're used to. There's potential for confusion and frustration if the integration isn't managed well.
So communication and customer support are key here as well.
Absolutely. Banks need to proactively tell customers about changes, provide clear instructions, and offer support to address any worries. This minimizes disruption and builds trust and loyalty.
It's a chance to strengthen the bank-customer relationship, not just maintain it. Are there broader societal impacts beyond the immediate effects on employees and customers that we should be thinking about?
Definitely. When you have smaller local banks being absorbed into larger national ones, you lose some local decision making. Decisions about lending, investment, community involvement, those might be made further away from the people they affect.
So there's this trade-off between the efficiency and scale of the big banks and the responsiveness and community connection of the smaller ones.
Exactly. And it's a complex issue with no easy solutions. Policymakers and regulators need to consider these impacts on communities and make sure everyone still has access to essential financial services.
So while there are economic benefits to consolidation, we can't ignore the potential social and community impacts. It's a good reminder that finance isn't just about numbers, it's about people.
Well said. It highlights the importance of a holistic approach to these amalgamations, one that considers the needs of everyone involved. The future of banking in India is being shaped right now, and understanding these mergers is key to creating a system that truly serves the nation.
I couldn't agree more. This deep dive has been incredibly insightful, giving us a glimpse into the complexities of banking amalgamations in India. We've covered so much, from the legal framework to the economic drivers, the challenges, and even the human stories that are often hidden behind these large-scale financial transactions.
It's been great unpacking all of this with you.
We'll be back soon with part 2, where we'll dive even deeper into some of the legal and regulatory aspects of these amalgamations, exploring the roles of institutions like the NCLT and the CCI, and getting into some specific legal concepts. Stay tuned.
Looking forward to it. Welcome back to LexTalks. Great to continue our deep dive into banking amalgamations.
I'm glad to be back, and I'm sure our listeners are ready to get into the legal nitty-gritty of these mergers. We left off talking about the complexities of integration, but I want to shift our focus to the role of law in this whole process. It's not just business decisions, there's a legal framework governing these amalgamations, right?
Absolutely. We touched on the Banking Regulation Act, specifically Section 44A, which lays out the rules for these mergers. But it's more than just one act. There's a whole web of laws, regulations, and institutions involved.
So it's not just two banks shaking hands and merging assets. There's legal oversight to make sure everything is done properly. Where do we even start unraveling this legal web?
Let's start with a key player we mentioned before, the National Company Law Tribunal, the NCLT. Remember, we talked about how they act as a watchdog, ensuring transparency and fairness in the process?
Right, they make banks publicize their merger plans and allow anyone affected to object. But what exactly does the NCLT do? How do they approve or reject these amalgamations?
Well, it's a multifaceted role. Once the banks have drafted their scheme and gotten approvals from shareholders and creditors, they file a petition with the NCLT, like presenting their case for the merger.
So the NCLT acts as a judge, scrutinizing the proposal.
Yes, but it's more than just approving or rejecting. The NCLT goes beyond just reviewing documents. They hold meetings with the shareholders and creditors of both banks, giving them a chance to voice concerns or raise objections.
That gives those potentially impacted a platform to speak up and ensure their concerns are heard.
Exactly. Remember those dissenting shareholders we mentioned? This is where they can formally present their case. And it's not just for shareholders and creditors. The NCLT also invites objections from the public. Anyone who might be affected, customers, competitors, community groups, they can all have their say.
Wow, that's pretty transparent. For such big financial transactions, it really emphasizes the importance of public input and scrutiny.
Absolutely, and it's crucial for maintaining public trust in the banking system. It's all thanks to the NCLT's role in ensuring a fair and transparent process. Only after considering all these inputs from shareholders, creditors, and the public does the NCLT hold a final hearing to decide whether to approve the scheme.
Sounds like a thorough and democratic process with lots of checks and balances.
It is. It shows how important a robust legal framework is for guiding these significant transactions. Now, while the NCLT focuses on procedure and stakeholders, there's another crucial player, the Competition Commission of India, or CCI.
Ah, yes, the CCI. We mentioned them earlier, making sure competition in the market is fair. But
Yeah.
what exactly do they do in banking amalgamations? Do they just rubber stamp the NCLT's decisions?
No, not at all. The CCI has a separate and equally important role. They're mainly concerned with making sure these mergers don't stifle competition and hurt consumers in the long run.
So they're like the referees, making sure everyone plays fair and no one gets an unfair advantage.
Exactly. Their job is to prevent anti-competitive practices and ensure a level playing field. So even if the NCLT approves a merger based on legal and procedural aspects, the CCI can step in and say, hold on, this might create a monopoly or reduce consumer choice. We need to investigate.
Makes sense. How do they go about that? What do they look for when scrutinizing these amalgamations?
They use various tools and analyses to assess the potential impact on competition. They look at market share, the number of competitors, barriers to entry for new players, and the possibility of the merged entity abusing its dominant position to raise prices or reduce choices for consumers.
So it's a detailed analysis, looking beyond just the financials of the merging banks and considering the whole market.
Exactly. Based on their analysis, the CCI can block a merger if they think it'll hurt competition. They can also impose conditions, like requiring the merged entity to sell off certain assets or businesses to keep the market balanced.
Wow, they have a lot of power to shape the outcome of these mergers. It's good to know there's an institution dedicated to protecting consumers and ensuring a healthy competitive environment.
It's a vital role, especially in a sector as important as banking. It's another example of how the legal framework in India tries to balance the interests of businesses, consumers, and the economy.
This is all really fascinating, but I'm curious about something. We've talked about the NCLT, the CCI, the Banking Regulation Act, but what about the RBI? They can orchestrate these mergers, but are they involved in the legal approval process too?
Oh, absolutely. While the NCLT and CCI focus on specific aspects, the RBI, as a central bank, has a broader perspective and a crucial role in ensuring the stability and soundness of the entire financial system. They're involved at many stages, providing input and scrutiny to protect depositors and the overall financial health of the nation.
So it's not just about checking boxes and following procedures. There's a real sense of responsibility and a deep understanding of the potential consequences.
Exactly, and it's this multi-layered approach with checks and balances from various institutions that gives the system resilience and builds public confidence in the banking sector.
It's like a well-oiled machine, different parts working together for a smooth and responsible process. But I have one more question. We've talked about the RBI's power to initiate these mergers, but is there a specific legal provision that gives them this power?
You're thinking like a lawyer. And yes, there is. It's Section 45 of the Banking Regulation Act. This section gives the RBI the authority to step in and start the amalgamation process if they think it's necessary, even if the banks themselves don't want to merge.
So it's like the RBI saying, we see a problem here, and for the good of the financial system, you too need to merge, whether you like it or not.
It's a powerful tool, and it highlights the RBI's role as the guardian of financial stability. They can use this power if they believe a merger is necessary to protect depositors, keep public confidence in the banking system, or even prevent a financial crisis.
Sounds like a last resort, something they wouldn't use lightly.
Exactly. It's a significant intervention that emphasizes how serious these decisions are and the potential impact on the whole economy.
This deep dive is really showing us the intricate connection between law, finance, and regulation in the Indian banking sector. It's amazing how these different pieces fit together.
And we're just scratching the surface. There are so many other legal concepts and provisions involved. For instance, there's novation, which is crucial for smoothly transferring contractual relationships from the merging banks to the new entity.
Novation, that's a new one. What does that involve?
Simply put, novation is a legal process where one party in a contract is replaced with another, with everyone's consent. So, if a customer has a loan with one of the merging banks, that loan agreement would be novated to the new merged bank, basically transferring the rights and obligations.
So for the customer, it's like nothing changed except for the name on the paperwork, but legally the contract has been transferred.
Exactly. This applies to any contract, not just loans, but deposits, credit card agreements, even employment contracts. It's a way to ensure a seamless transfer of obligations during the merger, minimizing disruptions for customers and employees.
It's like a legal magic trick, ensuring continuity amidst all the changes.
It's a clever legal tool that plays a vital role. But even with these tools and frameworks, a successful amalgamation needs more than just the legal and financial aspects. We can't forget the human element, the impact on employees, customers, and communities.
You're right. All the laws in the world don't matter if the human side is ignored. Finance is about people's lives, not just numbers and transactions.
Well said. And that brings up a crucial question that goes beyond legal and financial analysis. What about the ethics of these banking amalgamations?
Ethics. That's essential in any business decision, especially in banking. How do we even start to think about the ethics of these mergers?
It's complex with many angles to consider. Transparency and fairness are key. We talked about the legal mechanisms for transparency, but it's about more than just following the rules. Banks need to communicate clearly with everyone, explaining the reasons for the merger, the potential impacts, and how they'll address concerns.
So it's about building trust and making sure everyone feels informed and included, not just ticking boxes and meeting legal requirements.
Exactly. Another ethical consideration is the impact on employees. We've discussed potential job losses and cultural integration challenges. Banks have an ethical duty to treat employees fairly, supporting those laid off, ensuring a fair selection process for those remaining, and fostering a respectful and inclusive environment during the transition.
It's about treating people with dignity and respect, even when making tough business decisions.
Precisely. And then there's the impact on customers and communities, which raises ethical questions too. Banks must ensure the merger doesn't negatively impact access to essential financial services, especially for vulnerable populations in rural areas or those who rely on specialized services from smaller banks.
So it's not just about profits or shareholder value. It's about the broader social impact and making sure the merger serves everyone's needs.
Exactly. And then there's responsible lending. Mergers can push banks towards aggressive growth strategies, which might mean looser lending standards or a focus on high risk, high return products. Banks need to stick to responsible lending, ensuring they don't put borrowers at risk or contribute to unsustainable debt.
It's a reminder that ethics should be at the heart of every business decision, even when pursuing growth and efficiency.
Absolutely. And it's an ongoing process, not a one-time check. Banks need to constantly evaluate their practices, engage with stakeholders, and adapt to ensure they're acting ethically and responsibly.
It's about building an ethical culture throughout the organization.
Precisely. And it's not just the banks themselves. Regulators and policymakers also have an ethical responsibility to create a framework that promotes responsible behavior and holds banks accountable.
This discussion has really broadened my understanding of the ethical complexities surrounding these mergers. It's not just about following the law, it's about making decisions that align with values, fairness, and a commitment to everyone's well-being.
I'm glad to hear that. And it's a conversation we need to keep having as a society as the banking sector changes and adapts to new challenges.
I agree. This deep dive has been incredibly insightful, showing us not just the mechanics of banking amalgamations, but also the often overlooked ethical considerations.
It's been great exploring these nuances with you. Hopefully, our listeners are finding this deep dive helpful in understanding how complex the Indian banking sector is.
I'm sure they are. We've covered a lot in part two, focusing on the legal and ethical frameworks that govern these mergers. But there's still more to explore, and I'm excited to continue our deep dive in part three, where we'll look at the future of banking amalgamations in India.
That's right. We'll discuss the challenges, opportunities, and potential trends shaping this dynamic sector. Stay tuned for part three of our deep dive.
Welcome back to LexTalks. We're wrapping up our deep dive into the world of banking amalgamations in India, and I'm really interested to see what the future holds for this sector.
It's such a dynamic landscape, always changing and adapting to new challenges and opportunities. It's hard to say for sure what the future holds, but there are definitely some trends and factors that will likely shape the banking industry in the coming years.
So let's put on our prediction hats and dive into the future of banking amalgamations. What trends are you seeing that might lead to even more consolidation in the Indian banking sector?
Well, as we've discussed throughout this deep dive, the banking sector is facing pressure from many sides. You've got technology constantly advancing, with digital banking and fintech companies coming up with new innovations and disrupting traditional models. Then there's the push for greater financial inclusion, bringing banking services to those who haven't had access before, which requires a lot of investment and effort. And of course, there's the ongoing need to improve efficiency, manage risk, and keep up with changing regulations.
It sounds like a lot to juggle.
It is, and it's all pushing the industry towards consolidation, with mergers seen as a way to navigate these challenges and come out stronger on the other side.
So joining forces to create a more powerful entity.
Exactly. Amalgamations can give banks the scale and resources they need to invest in new technologies, expand their reach, and stay competitive in a rapidly changing market. They can also help streamline operations, cut costs, and improve risk management.
It's like teaming up to build a stronger, more adaptable ship, one that can handle the rough seas ahead.
I like that analogy. And it's not just about survival. Mergers can create opportunities for growth and innovation. Combining their strengths, banks can move into new markets, create new products and services, and connect with new customers.
So it's about more than just size. It's about becoming better, smarter, and more adaptable.
Exactly. And I think we'll see a change towards more strategic mergers in the future, with banks choosing partners who can help them reach specific goals. Maybe that's expanding geographically, boosting their tech capabilities, or diversifying what they offer.
It's like finding the perfect match, creating a banking power couple.
That's a great way to put it. I also think we'll see a bigger focus on integration. Banks are learning from past mergers, realizing that just merging on paper isn't enough. They need to invest in their people, processes, and technology to create a truly integrated organization, one that uses the strengths of both partners while minimizing disruptions for customers and employees.
So it's not just about the deal, it's about what happens after the merger is done. That's when the real work begins.
Absolutely. And I think innovation will also be a major focus going forward. Mergers can be a breeding ground for innovation, bringing together different ideas, perspectives, and cultures. Banks that can encourage innovation and experimentation will be in a better position to succeed in the long run.
Like shaking things up and seeing what new and exciting things come out of it.
Exactly. And I think financial inclusion will continue to be important. The government has done a lot to make banking services available to underserved populations, and I think that will continue. Mergers can contribute to this by expanding banking networks and allowing banks to invest in the infrastructure needed to reach rural communities and those with lower incomes.
So it's not just about big banks getting bigger, it's also about using these mergers to make banking more accessible and fair for everyone.
Precisely. And that's a key point to keep in mind as we look at the future of banking amalgamations in India. These mergers have the potential to create a stronger, more efficient, and more inclusive financial system, one that benefits everyone, not just the banks themselves.
It's a hopeful vision for the future, and it reminds us that these mergers are about more than just numbers and transactions. They can impact millions of people and influence the entire Indian economy.
Well said. And as we move forward in this ever-changing landscape, it's crucial to have informed and nuanced discussions about the potential benefits, risks, and ethical considerations that come with banking amalgamations.
Absolutely. We need to make sure these mergers are guided by principles of fairness, transparency, and a genuine commitment to the well-being of all stakeholders.
I completely agree. And as we've seen throughout this deep dive, there's a complex interplay of market forces, regulatory oversight, and ethical considerations that shape the outcomes of these mergers.
It's a fascinating area to explore, and I'm sure we'll be revisiting this topic in future episodes of LexTalks as things continue to change.
Definitely. It's always a pleasure to delve into these complex issues with you and our listeners.
Thank you for joining us on this deep dive into the world of banking amalgamations in India. We've explored a lot, from the legal framework to the economic factors, the challenges, and the potential future trends that are shaping this dynamic sector.
I hope our listeners found this deep dive helpful and informative. It's a complex subject, but it's essential to understanding how the Indian financial system is evolving.
As we wrap up this episode, we encourage you to stay curious, keep learning, and engage in thoughtful discussions about the issues that matter to you.
Your voice and your perspective are important, and we need to have open and informed conversations about the future of banking in India.
Thanks for tuning into Lex Talks. Make sure to subscribe to stay updated on future episodes, where we'll continue breaking down complex legal topics and making them accessible to everyone.
Until next time, keep simplifying the law.